Everyone has seen by now that GameStop's share price increased by a crazy magnitude at the end of January by 1,700%, which is a huge increase for a fairly unvolatile stock. The controversy is that the hedge fund Melvin Capital Management LP had bet against GameStop and lost a lot of money trying to sustain this short position, while the rest of the market pushed the price up. We describe the key players, what happened, and finally ask what lessons can be learned. We highlight the intriguing role of Citadel in this story, as they are both customers of Robinhood as well as helping out Melvin Capital. So who are the main players in this story? First, GameStop, a games retailer not doing too well before the whole controversy started. Physical video games have been in decline for a while now, as games are becoming easier and quicker to download directly. GameStop, which was founded in 1984, had at one time close to 6,000 retail stores selling games. Its downward spiral began in the late 2010s, getting really bad in 2018, when they made a loss of almost $700 million. COVID has obviously not been good for the company, and despite a 500% increase in online sales, they ended up closing almost all of their physical stores last year. Another agent is Reddit, the online news and discussion site, which has the now infamous subreddit Wall Street Bets, that discusses stocks and options trading and began what's known as a short squeeze on GameStop on January the 22nd this year, driving up the share price, which has contributed to the meteoric increase in GameStop's value. Next, the trading platform Robinhood is the main one in the story, but there are of course others like Acorn and Charles Schwab. Robinhood claims that they provide free trading of shares, but this seems to be coming at a cost of selling their customers' trades to hedge funds such as Citadel. Therefore, there are big companies who know in advance what retail customers are going to be doing. This might be especially illuminating if they were heavily betting against a certain stock. Interestingly, Robinhood started out with a view to democratizing the trading of stocks, but to make money they find themselves on the same side as the big banks and hedge funds. The last two players are the hedge funds involved, Melvin Capital Management LP, founded in 2014 by someone who worked at Citadel, and they manage around $12.5 billion. And lastly, we have Citadel, one of whose businesses is a hedge fund, the other being a market maker who both buys and sells equities and other securities, and Citadel Technology, which sells investment management technology. A few quick definitions that have been flying around. Shorting stock. Shorting is simply when you think that the price of a company's stock is going to go down. You bet against the company. It involves borrowing a stock from someone, selling it at price X, hoping that the price decreases, then later buying back the stock at price Y, hopefully lower than what you sold it at. The interesting thing about shorting is that it can lead to infinite losses. If the price of the share which you need to buy at increases and increases, you still have the obligation to buy it. How does this relate to another term, short squeezing? A short squeeze is an increase in the price of a stock that is driven by short sellers liquidating their positions, meaning that they are executing the buying back part of their trade. Their demand increases the price of the share that they're betting against, which is obviously not good for them. Unfortunately for those who are shorting, this can start a spiral, whereby others who have also shorted buy up more of the stock, which leads to a further price increase. Short squeezing can be exacerbated when there are a limited number of shares in the stock available, which was the case with GameStop. Now that we've covered all that, what actually happened? Melvin Capital LP and other places decided to short GameStop stock. The subreddit Wall Street Bets decided to buy up shares of GameStop, which drove up the price. Eventually, the demand for this share was such that Melvin Capital and other shorters smelled trouble and frantically tried to close their positions. That is the buying up of stock that led to the aforementioned short squeeze. Robinhood limited trading on GameStop and only allowed traders to close out their positions, causing class action suits and general outrage. It was later revealed that this was due to liquidity constraints on their part to meet their own deposit requirements during such a volatile week. Citadel and another hedge fund helped Melvin Capital LP with a cash injection of $2.75 billion, receiving non-controlling revenue shares. However, Melvin still made a loss of about 50% of its assets in January. As mentioned before, Citadel used Robinhood's buy flows to figure out what's happening in the market. Is it possible that they knew about a huge increase in sales of GameStop stock and what it would mean for short sellers like Melvin before they gave their cash injection? Who knows? As of the making of this video, GameStop's shares have dropped to $90 from a high of around $340 only a few days ago. So what can we learn more generally from this? There is always a price. If a service such as trading stocks is being marketed as free, we need to ask ourselves what information we are paying with. Next, short selling can be a helpful and disciplining force in the market, a helpful signal that something is amiss. And lastly, the narrative of a sensible, well-disciplined stock market is just a myth. The stock market has never been a transparent place where there is not some kind of market manipulation, be it insider trading, aggressive trading by big players to influence the price, and stock buybacks, to name just a few.